You're at zero, not a little invested, not kind of started. Zero. Your bank account isn't building wealth. Your money isn't compounding. And every time you hear someone talk about investing, it feels like they're already 10 steps ahead of you. Maybe you've got debt hanging over you. Maybe you're living paycheck to paycheck. Maybe you just feel late. Let me say this clearly. You are not late. In fact, starting from $0 in 2026 might be one of the most powerful positions you can be in. Why? Because zero forces clarity. When you have nothing invested, there's no confusion, no messy portfolio, no random crypto buys from 2021, no emotional baggage from panic selling. You get a clean slate. And today, we have something previous generations didn't: instant access. You can open an account in minutes. You can invest with a single dollar. You can automate the entire system so it runs without you thinking about it. The real difference isn't money. It's having a plan. And if I lost everything today, if my net worth went to zero, I wouldn't panic. I'd follow a system. In this video, I'm going to show you exactly what that system would look like, step by step. No hype, no unrealistic promises, no get rich by next month nonsense. Just a clear blueprint for turning zero into momentum. Here's how we're going to break it down. First, the foundation. What must be in place before you invest a single dollar? Second, how I would build my first $10,000 from scratch. Third, exactly what I would invest in, specific categories, specific structure. Fourth, how I would automate and scale the process so it grows consistently. And fifth, the mindset that separates people who build wealth from people who quit halfway through. If you're serious about changing your financial trajectory starting this year, this is where it begins. Let's start with the foundation. Before you even think about buying a stock, before you download a brokerage app, before you watch another investing video, we need to talk about the foundation. Because investing without a foundation is like trying to build a skyscraper on sand. It might look fine at first, until it collapses. Step 1. Eliminate high-interest debt. If you're carrying high-interest debt, especially credit cards, that's your first mission. Let's run the numbers. Imagine you owe $8,000 on a credit card with a 24% interest rate. That's nearly $2,000 per year in interest alone. That means every year, before you even make progress, $2,000 quietly disappears. Now think about this. The stock market historically averages around 8 to 10% per year over the long term, but your credit card is charging you 24%. Which one is mathematically smarter? Trying to earn 10% or eliminating a guaranteed 24% loss? Paying off that debt is like locking in a risk-free 24% return. You won't find that anywhere else. High-interest debt is financial quicksand. The more you ignore it, the deeper you sink. So before you invest a single dollar, eliminate it. Step 2. Build a 3 to 6 month emergency fund. Once the debt is handled, we build your safety net. Because life doesn't care about your investment plan. Cars break down, jobs change, unexpected bills show up at the worst time. If you don't have cash set aside, what happens? You swipe the credit card again. Or worse, you're forced to sell your investments when the market is down. And that's how people lock in losses. Investing without an emergency fund is like riding a roller coaster without a seatbelt. When the market drops, and it will drop, you need stability. An emergency fund gives you options. It gives you breathing room. It gives you confidence to stay invested when everyone else is panicking. Aim for 3 to 6 months of essential expenses, not luxury spending, not vacations, just the amount you need to survive comfortably. Why this matters? If you invest while you're financially unstable, every market dip feels like a crisis. But when your foundation is solid, market volatility becomes noise. You stop reacting emotionally. You start thinking long-term. That's the difference between someone who builds wealth and someone who quits halfway through. Your checklist. Before moving forward, ask yourself,
Do I have zero high-interest debt? Do I have 3 to 6 months of expenses saved? If the answer to either question is no, that's your focus.
Not stocks, not crypto, not options. Foundation first. This is non-negotiable because once this is built, everything else becomes easier. Now that your base is secure, we can talk about building your first $10,000. Now that your foundation is solid, we focus on your first real milestone, $10,000 invested. Why $10,000? Because this is where things start to feel real. It's the point where momentum begins. But let's be honest, going from $0 to $10,000 isn't about investing, it's about behavior. Phase 1. Increase your income. If you're starting at 0, your income is your biggest asset. In 2026, skill pays. You can learn high-income skills online. You can freelance. You can use AI tools to work faster and smarter. You can stack skills, not just one, but combinations that increase your value. And while you're increasing income, avoid lifestyle inflation. When your income goes up, don't immediately upgrade your car, apartment, or spending habits. Upgrade your investments. Phase 2. Aggressive saving system. Now we create a system. Let's say you earn $3,000 per month. If you commit to investing 25%, that's $750 per month. $750 times 12 months is $9,000 in 1 year. You're almost at $10,000 in just 12 months. Even if you only manage 20%, that's $600 per month. You hit $10,000 in around 16 to 17 months. That's not decades, that's discipline. The key is percentage-based saving, not "I'll invest what's left." You invest first, then you live on the rest. Here's the truth. The first $10,000 is the hardest. It requires effort. It requires sacrifice. It requires consistency. But once you hit that number, the game changes because now your money starts helping you. And momentum? Momentum builds fast. Once I have money ready to invest, I keep it simple. No hype, no guessing, no chasing whatever's trending this week. Here's my structure. 70 to 80% into an S&P 500 ETF like VOO, SPY, or IVV. This gives me exposure to 500 of the largest companies in the U.S., instant diversification. 10 to 20% into a growth-focused ETF like QQQ. This leans heavier into technology and innovation. And if I want a little extra upside, 5 to 10% into higher-risk growth stocks, money I can afford to be aggressive with. That's it. I'm not day trading, I'm not trying to outsmart the market, and I'm definitely not chasing the next big thing, because history shows something important. Over the long term, the S&P 500 has averaged roughly 7 to 12% annually. Not every year. Some years are red, some are green, but over time, the trend has been up. I also pay attention to expense ratios. Lower fees mean more of the return stays with me, and diversification protects me from betting everything on one company. Simple rule: buy the haystack, not the needle. Own the market. Let time do the heavy lifting. Now let's make this real. Step 1. Choose a brokerage. Fidelity, Vanguard, Schwab, all solid options. Pick one and move forward. Don't overthink it. Step 2. Choose your account type. If you want long-term tax advantages and you're investing for retirement, open a Roth IRA. If you want flexibility, no withdrawal restrictions, open a taxable brokerage account. Step 3. Link your bank account and transfer funds. Start with whatever you can, even small amounts count. Step 4. Search the ETF ticker you decided on, for example, VOO or QQQ. Step 5. Select the amount of shares you want and place a simple market order. Done. And here's the most important step. Step 6. Turn on automatic monthly investing. Set it, automate it, let it run. No emotions, no second guessing. Congratulations, you're officially building wealth. This is where most people fail. Not because they picked the wrong ETF, but because they couldn't control their emotions. Market crashes will happen. 2008,
the market collapsed. 2020, COVID panic, portfolios were cut in half, and yet the market recovered, then went on to reach new highs. Here's the rule: you don't lose until you sell. If you panic and exit when everything is red, you lock in the loss. But if you stay invested, history shows the market trends upward over time. Time in the market beats timing the market.
You don't need to predict crashes. You need to survive them. That's why dollar cost averaging works. Invest monthly, automatically, whether the market is up or down. Because here's something most people don't realize. If you miss just a handful of the best days in the market, your long-term returns can be cut dramatically. And those best days usually happen right after the worst ones. So stay consistent, stay invested, stay calm. Think 2026 to 2036, not this week, not this month, a decade. That's how wealth is built. If you're starting from $0, fix the foundation. Build your first $10,000. Invest mostly in index funds. Automate everything. Stay patient. That's the blueprint. And remember this, you're not broke, you're early. If you want the full checklist I use to stay on track, I've put it together for you. And I'm curious, how much are you starting with in 2026? Drop it in the comments. I'll see you inside.